Concerns among leading analysts of a technical recession, with Singapore's GDP growing just 0.1% year-on-year in the first quarter of 2023, dragged down by weakness in manufacturing. The Q1 growth is slower than the 2.1% expansion in the previous quarter. On a quarter-on-quarter seasonally adjusted basis, GDP contracting by 0.7%. By sector, manufacturing contracting by 6%, worsening from the 2.6% contraction in the quarter prior. It's due to shrinking output across all but the transport engineering cluster. On the other hand, construction adding 8.5%, extending the 10% growth in the previous quarter on a pickup in both public and private sector construction activities. Meanwhile, services growing by 1.8% against 4% in the quarter before. Only the wholesale and retail trade cluster declined among the services producing industries in Q1. Alongside those official advance estimates, the Monetary Authority of Singapore leaving its monetary policy unchanged, pausing a series of tightening moves since October 2021 to fight rising inflation. The width and the midpoint of the policy band were also left unchanged. In its biannual monetary policy statement, MAS describes its current policy stance as being appropriate for securing medium-term price stability, while flagging the risk of a deeper than anticipated slowdown in the Singapore economy amid higher risks to global growth. Joining me now is Irvin Seah, Senior Economist at DBS. So Irvin, let's start with MAS's unchanged monetary policy. It's largely a surprise, with most analysts expecting another round of tightening. Could you help us further understand the rationale of MAS's decision to pause its tightening moves?
Well, first and foremost, it didn't come as a surprise to us because we had early on expected that the MAS will stand pat and it will pause on this current tightening cycle. Now, there are a few reasons for doing that. The most important thing is that inflation, although it is still a concern, but it is no longer as big a concern as compared to growth, because ultimately the mandate of the central bank is to strike a balance between inflation and growth. And what we have seen in today's GDP number as well, that there are certainly a picked up in terms of the downside risk to growth. So growth has weakened significantly on that. On the other hand, inflation has been a concern for the past 1 to 2 years, but inflation has peaked. In fact, it has peaked at about 7.5% in October last year. And since then, for the past few months, it has been moderating. Now that with inflation's easing off, in fact, inflation would have been even lower if not for GST. But the fact is that inflation will continue to ease off for the rest of the year and heading into 2024. So with inflationary pressure less of a concern, but now increasing focus on growth, then it makes sense for the MAS to strike a balance, to rebalance its monetary policy. Now, having said that, a lot of people had misperception that by rebalancing, the MAS would have to either ease off on monetary policy. We have to be mindful that coming to a pause, the single policy band, it is still on an upward sloping trajectory. So that means the Sing dollar is still appreciating against a basket of currency. So therefore, it is still sufficient to address any concerns pertaining to inflation while not incurring any detrimental impact on growth. Now, on that part, I also want to highlight that the stronger the Sing dollar is, the more detrimental it is on our exports as well as the manufacturing sector. And as it is now, our non-oil domestic export is already below 2020 COVID levels. So that is definitely a concern for the economy. And henceforth, there isn't any further needs to tighten monetary policy any further.
Good points there, Irvin. So moving on to those GDP figures, to reiterate, the Singapore economy growing by just 0.1% year-on-year, lower than expected. Any good news at all, Irvin, or are we heading for a technical recession?
Well, 0.1% on year-on-year basis is weak to begin with. Henceforth, I don't think there's anything to cheer about. In fact, if you look at a quarter-on-quarter basis, that is where the real worries lies in, because a decline of 0.7% is not a good thing. And if we do get another quarter decline in the second quarter, that essentially means that the Singapore economy is in a technical recession already. But having said that, we think that the second quarter, there could be some bounce back in the manufacturing sector, as well as the services sector. Now, manufacturing sector at this point in time is definitely in the doldrum. The manufacturing sector is in recession, so to speak. But we expect that the manufacturing cycle has hit the bottom. So in the second quarter, we'll see some improvement. And in services sector, this sector economic growth momentum is waning. However, there is outlier, and that is the hospitality sector. And this sector actually has benefited from an increase in inflows of tourist arrivals, particularly from China. Now, China's reopening has been a very important pivotal factor for Singapore economy, and we're going to see more and more such positive spillover, particularly in the second half of the year. As we see more tourists coming to Singapore, and also with growth improvement in China, it could actually provide some respite for our manufacturing sector. But in a nutshell, we expect full year GDP growth to register 2.2% this year. So definitely not a recession, but at 2.2%, we also have to be mindful that it is below the potential growth rate of 2.5% to 3.5% for Singapore. So this is definitely subpar growth, on a general basis.
Irvin, the government has estimated GDP growth of 0.5 to 2.5% for 2023. You mentioned a 2.2 estimate earlier. Could you elaborate on your take on where the GDP will fall in this rather broad range? And what do you think could help or hinder our GDP growth, domestic and external factors? You also mentioned China earlier.
Yes, correct. So I think the government is taking a very cautious approach in their estimates, which is why they maintain the forecast of 0.5 to 2.5%. But do know that actually this forecast has been, put forth, I think slightly before the reopening of China economy, before that was announced, which is in December last year. So we do expect that China's reopening basically would prompt stronger growth in China, which then in turn translate to stronger demand for Singapore's exports and henceforth on the manufacturing sector, which is currently struggling. So this will be a lifeline for the manufacturing sector in the coming quarters. And from the services sector, right now, yes, we're seeing more Chinese tourists coming to Singapore, but it is only at 20% of pre-COVID level. So there is still definitely, a lot more room for the Chinese tourists in terms of arrivals, and that definitely will provide further lift to the hospitality sector in Singapore.
Your perspectives are always appreciated, Irvin. Many thanks to Irvin Seah, DBS's senior economist. Thanks for watching. Be sure to subscribe to the channel and hit the bell icon to be notified of new videos.